Ladies and gentlemen, buonasera. Professor Monticelli, Professor Tabellini, members of the Baroli family, it's indeed an honor to be here. I have to tell you that I went onto the Bocconi website and said, history of the Baroli lecture, and nothing came up except me. And Professor Tabellini just explained why, so it's a doubly great honor, and I will try to live up to it. I would like to introduce my wife, Juliana Ferreno, who's here with me. She's heard some of this before, so I'm pleased that she decided to come. I would like to talk about some major challenges in the global economy that are associated with unstable equilibria, risk, multiple equilibria, and so on. And I'm going to be talking about things that anybody with any humility would agree are things that we really don't know the answers to. That is, we're on a journey, as Professor Monticelli just said, of sort of living through a time that we've never lived through in the global economy, and I'll try to illustrate that in multiple dimensions. So we're trying to make sense of it, we're trying to build the conceptual frameworks that we need to do it, and we're trying to use the frameworks that we have to try to understand some of this dynamics. No, I hope this thing works. This is just my credentials. As was said, I chaired a commission on growth. I wrote a book that I'm not going to talk about much today, which in English is called The Next Convergence, and then in Italian, La Convergenza Inevitabile. It's not quite the same, but it's close. I've worked in China on policy issues that are very hard, where the government thinks international expertise of a variety of kinds would be helpful, and I and another chap have tried to collect that expertise from around the world. And I've recently focused my attention on the structural challenges in the advanced economies. I'll show you a little bit about what's happened in America and Germany if I have time today. And I'm working with a young graduate student here, Nicola. Nicolo's last name has escaped me for the moment. And we're going to try to see if we can collect the same data for the Italian economy. And finally, I wrote a book called Market Signaling, that the best short description of it I've ever heard was just given to you by Professor Monticelli. And I'm going to come back to it, because I learned something in the course of doing that research that's relevant today, and that is, what are the structural conditions under which you get dangerous multiple equilibria? So that's my game plan. So I'm going to start with Europe. And then I'll go to the structural advances in the challenges in the advanced countries. If we have time, I'll talk to you a bit about emerging market growth and their decoupling from us. And finally, you know, the third largest economy in the world and the world's growth engine is China. They're going through a very complex transition. And so I brought along some material on that. To be honest with you, I'm not sure I'll make it, but I'd be pleased to talk about it. And lastly, I'll mention 3 disruptive technologies that I think could change the world we live in. There may be more, but these are the ones that have gotten my attention. So here we go. I go at this as somebody who has spent the last 10 years of his life thinking about growth and growth models. And in the course of this work, both in developing and advanced countries, I've accumulated quite a large collection of models that don't work. that have built-in flaws that eventually bring them to a screeching halt. I've listed them here. I'm not going to talk about them in any detail. Some of you will recognize them. You know, a standard bad model in the old days in developing countries was the import substitution model, where you closed yourself off from the global economy. There's an advanced country version of that practiced by Canada, where I grew up. Australia, New Zealand, doesn't work. But there are 2 I do want to focus on, and that is what I call the excess consumption model, where by consumption I mean both private and public with different mixes, because this is the model that has in part destabilized the advanced countries, including the United States, some of the countries here in Europe, including this one. And it's a bad model. It generates aggregate demand. It's usually accompanied by excessive accumulation of debt somewhere in the economy. And it results in a loss of competitiveness and excessive reliance on domestic demand for growth and employment, and eventually it can't keep going. We've experienced that in the United States. You're starting to see it here. There's the mirror image of that problem which is the excess investment model. And this is the one that confronts the Chinese. So the Chinese have been living in an economy that was where the growth was driven essentially by exports, everybody knows that, and by investment, huge, high levels of investment, 45% of GDP. And they are now entering a period in which they're trying to stick to that model when it doesn't work anymore. And the investments are starting to have low returns. And for those of you who know a bit of economic theory, you know that's a trap. It's like driving up a canyon where you can't get out the other end. So with that as background, let me just start talking about the world we live in the advanced countries. I think we're in what I sometimes call a perfect storm. We've had a massive failure of what is sometimes called counter-cyclicality. That is, saving in the good times so that you've got ammunition to deal with the bad times. In both the private and the public sectors. It varies across countries. Europe has tended to overspend on the public sector side. America has had and still has a huge excess consumption, excess leverage, asset bubble creating pattern of growth. As a result of all that, we had a buildup of liabilities on the public sector side. Both formal debt, I'll show you this in a minute, both formal debt and non-debt liabilities. And much of the recent increase that's occurred in the post-crisis of 2008-09 and now again in Europe has occurred on what I call autopilot. By that I mean it basically happens automatically. Government revenues fall, safety net payments rise, and you're in trouble. The IMF estimates that 80% of the run-up in deficits and the deteriorating fiscal situation is actually attributable to that kind of thing. Italy is abnormal because the previous government's economy and finance minister, Giulio Tremonti, realized that with a debt to GDP ratio of 120%, we couldn't do that. And he prevented, by various policy actions, the run-up of the deficit in Italy. And that, of course, had an adverse effect, at least in the short term, on growth. I actually think that was entirely wise policy. Running up the debt with that starting point wouldn't have been smart. As I've said, we had growth models as decelerators, and most of us have demographic headwinds, which means we're getting older. We've run up debts that our children and grandchildren are going to have to pay, and they're not very numerous in many of our countries relative to us. I view the intertemporal choices that we've made, sometimes I think inadvertently without knowing what we're doing, and maybe sometimes even deliberately, as almost ununderstandable. And of course, these systems break. At some point, if you have 50% youth unemployment and massive overhang of debt, something will happen that sounds like an objection. Now, this is a picture of the trending pattern of government debt in relation to GDP, and it is very simple to read. The advanced countries are trending up toward 100%, with some above, some a little bit below, and the developing countries, all of them, are trending down, including the poorest ones, are trending down to something like 40%. Now, I think it's fair to say that if I got a bunch of people in this room together 15 years ago, those of you who are old enough to be gotten together at that time, and said, what's the probability that you would see this graph 15 years from now? I bet you would have said, it's impossible. There's no chance. I mean, all of this kind of thing occurs in developing countries. Well, it's happened. This is a picture that I'll use several times in this discussion of Europe. This is total debt for a variety of countries. And I find this graph particularly interesting. So total debt means debt everywhere in the economy, not netted out, right? And it's got four components: government debt, sovereign debt, non-financial corporate debt, household debt, and then the financial institutions debt. Think of it as banks and other financial institutions. Now, there's several striking things about this. The two big outliers on aggregate debt are Japan and the UK. So it may not be surprising that the UK has decided a certain amount of deleveraging and implied austerity have to go with that. And then there's a whole bunch of countries of which Italy here is one, that have high debt levels. I don't think these numbers are ideal, but we're not out of line. What we're out of line on right now is the public debt component. And the reason we're not out of line on the whole is well known in this country, which is that the household sector doesn't borrow very much. And it's a high saving country, at least in the past. I know the savings rate's coming down. It's also a wealthy country. So the aggregate balance sheet of Italy is actually quite strikingly healthy. And the problem, I think correctly, is to reconfigure this balance sheet in such a way that it kind of makes sense intertemporally, economic and socially. That's easy to say. It's a lot harder to do. This is a picture, these are hard to estimate, but I think the picture's generally right, of the non-debt liabilities of a collection of countries, and that's the orange. And what you can see is they're huge. And they're much bigger than the sovereign debt numbers, which are the little things in green. That's official government debt. And this worries people. When I get to the United States, I'll suggest that, you know, gridlock in that country's government is quite likely at some point to cause the financial markets to react violently to the situation. Now, the good news about these liabilities is they're long-term. That is, they run out 30, 40 years. So if you change the parameters of the programs that determine these liabilities, you can actually reduce them by a fair amount and reduce them in time. That's the good news. The bad news is because you don't have to do it now, it's easy to wait. And if you keep waiting and waiting, eventually, you know, you'll drive into some kind of financial wall. And that, I think, is the reason why people think, you know, sometimes a crisis is a good thing because you don't waste it occasionally. But these things are worrying. So that's the situation we're in. Now, I want to talk about the extreme macro risk and uncertainty. But let me say before I do that, that globally, our interests are aligned. Let me explain what that means. If you go to China, as I do often, and ask, what are your major risks? They'll say, well, there's two kinds. There's external, that is us, over here, and there's internal. And you say, well, which ones are the bigger ones? Now, people can have disagreements about this, but they say the external risks are bigger. It's not that the internal risks don't exist. They might goof up on the sort of growth and development strategy and process, but they say the external risks are with us, and they're thinking of mainly Europe and the United States with some weight attached to Japan. And then you ask the question, you know, well, what kind of game is this we're playing? Is that sort of good or bad for them? And the answer is, well, it's terrible. You know, China, if they could vote, would vote immediately for a restoration of a sustainable pattern of growth and fiscal stability in both Europe and America. There wouldn't even be a question. Ditto, if Europe takes a nosedive, that is, we get what I'm going to call in a minute the bad equilibrium, then it will go across the Atlantic in a heartbeat. We are each other's major trading partners. And so, and vice versa. I'm not going to do all those pairwise things. But the bottom line is everybody has a huge stake in China continuing its sustained high growth, and in Europe and America going back to a stable pattern of growth with stable fiscal sort of underpinnings. Now, what are the, now we have multiple players in this game, and that complicates it. So let me, just to help you follow me along, I use a very simple framework when I'm thinking about these challenges associated with unstable situations. And it has three words in it: resources, competence, and will. Resources refers to whatever entity we're talking about, it could be a government, usually is, has the big enough balance sheet and the instruments, the policy instruments to deal with the problem in principle, okay? The second one is, do the people who have their hands on those balance sheets and instruments know what they're doing? That's what competence means. And the third one is political will. You know, even if you have the resources and you know what you're doing, will a political system and the pushing and shoving that's going with that result in a forceful reaction, effective reaction to the problem? There are exceptions to what I'm about to say, but almost all the risk, as best I can see, when you really focus in on it, is associated with political will. There are relatively few examples of countries that don't know what they're doing or have resources that are so limited that they can't on their own get out of the situation they're in. Not everybody agrees with this, but Greece is one that flunks the resources test. And it is why I have said over the last 2 years that Greece and its citizens will eventually decide that it is in their best interest to exit the eurozone. Now, you and I know that's risky because of the contagion effects, but if you're 40% out of bounds in terms of productivity relative to what it takes to compete both in Europe and globally, then you've got an awful lot of deflation to go through in order to restart the growth engines. And the normal way that's done in any country, including developing ones, is you have a one-time devaluation that resets the terms of trade so that you restore competitiveness. Now, that's not a substitute for a productivity increasing growth strategy. I think everybody knows that. I mean, you can fritter that advantage away, so it's not a silver bullet in any sense of the term, but not having it available as a policy instrument puts you in a very, very tough position. Basically, you've got a sort of a huge burden-sharing problem where you're trying to figure out how to kind of shrink everybody's incomes down so they match the productivity levels of the country. So one risk we're going to face in the immediate term is that we'll have contagion. Now, there's two ways to think about contagion. One is kind of on the merits, right? Everybody, I think, that looks carefully at this knows that what I just said about Greece is not true of Italy and Spain. That Italy is a rich country with a dynamic north. I'll review the positives in detail in a minute. There's no way on earth that a sensible person could reach the conclusion that this ship can't be righted with a little help from the ECB and the IMF. And I think the same thing's true of Spain, although, frankly, maybe it's a little bit closer to the margin. But that doesn't mean contagion won't occur. If some of you may remember the Asian currency crisis in 97, 98, when Thailand, and then a sequence of countries, the worst case was Indonesia because it produced social unrest, that spilled over to Latin America. I have Latin American friends who came to me and said, "What's that got to do with us?" And I said, what it's got to do with you is that the investors don't know the difference. This is imperfect information, folks. And the way asset classes get defined, notwithstanding what those of us in finance tell you, they have to be defined by virtue in terms of the information you have to available. If the investors can't tell the difference and they're a bit scared, they'll act as if they're in the same class. And that means, in this context, that you could see an additional flight of private capital from the sovereign debt markets in Italy and Spain. There is a clear circuit breaker for that, and that is the Eurozone core, the ECB, and Germany at the center of the Eurozone core. They have to stop this if it starts. And I'm right that Greece exits. If that doesn't happen, then you'll get a run-up in yield and a self-confirming process where the private capital stays away. You will get up in the morning and discover that the yields and the risk spreads are high and staying high in Europe, and then eventually the incentive structure to play this game indefinitely will start to move in the direction of maybe there's a better game to play. That is the downside risk associated with contagion. That's also the downside risk in general. So let me pause and do something. This is slightly nerdy, and I apologize. Because I did the work on signaling, in talking with a good friend of mine, Mohammed Al-Arian, who's the CEO of PIMCO, who's much more knowledgeable about financial markets than I am, I got to asking myself the question, why do we keep seeing bimodal distributions? You know, when finance theory says that, you know, there's tail risk and then everything else is in the middle. And we realized that it was because there's really two scenarios. And after I thought about it for a while, I thought, I've seen this before. These are multiple equilibria situations. And so I'm going to tell you what structures create multiple equilibria. There's only really two critical features, and signaling models have them, but lots of other things do too. One, expectations are an important endogenous element in the model. That is what people believe is going to happen. But the second one's crucial and is not present in every place where expectations are important. And that is when expectations shift, they produce a large change, underline, large change in the incentives, behavior, and market outcomes conditional on those expectations. That turns a situation in which expectations converge to something that's sort of accurate into a situation in which expectations converge to something that's self-confirming. Do you see the difference? To expectations, when they have a big effect on the outcomes, then cause the actual market outcomes to shift, and so you can get multiple equilibrium configurations. Now, what's a simple example of this? Banks. Banks always have multiple equilibria. If you turn the expectations against a bank, regardless of whether it's solvent or not, the deposits will disappear and the bank will go out of business. So the two equilibria are the bank's in business and everybody feels safe, and the other equilibria is everybody's gone and the bank doesn't exist anymore. Now, the reason you don't see that, and this is another important factor for us today, is because everybody knows that model, and there are policy circuit breakers. The central bank intervenes and turns the liability side of the bank's balance sheet into liquid assets so they can give the money to the depositors, and the deposit insurance system makes everybody feel safe. So you almost never see the bad equilibrium in a banking situation. Now, we've got two of them now. One we saw in 2008, where we nearly went into a double downward spiral with the epicenter of that business in America. Well, what happened in America is because of the very high debt levels, when sentiment changed against asset prices in the market and they fell, there was huge balance sheet damage because of the high leverage in both the financial sector and the household sector. Now, you won't relate to that in Italy because the household sector is not highly leveraged, but it is in America. That balance sheet damage then caused very large changes in behavior by consumers, by companies in terms of investment and employment, all right? And that fed back into the asset markets, and asset values fell further, and wealth effects got bigger, and it started to run. You can sort of see how this happened. That was stopped by massive coordinated intervention by both governments and central banks all over the world, right? Otherwise, we would have been in the bad equilibrium. And the second big important example is what's going on right now, here. So the way I think about it is as follows. It's got several key things that need to happen in order for this to reach the good equilibrium. First, the reform processes in Italy and Spain have to succeed. And they have to succeed both in fiscal terms and growth. They're too closely connected. You can't fix deep fiscal imbalances in a no-growth environment, you know, and have it sort of pass muster socially. So that's one. And secondly, because that'll take time, the center has to take the position that they're willing to buy that time because the private investors are basically, to the extent they're investing in European sovereign debt, it's going into Northern Europe and especially Germany, and it's definitely not yet coming into Southern Europe, in particular Italy and Spain. And so if you don't have that backstop, which is the circuit breaker, then you can get a yield run-up. It will undo all the austerity that's been gone through, and then eventually somebody will get up in the morning and say, as the Greeks are starting to do now, from a much deeper, worse position, deeper hole, this is not a game we should be playing. So those are the two equilibria, and right now, where are we? We're right in the middle, with maximum uncertainty about, and we're in what I call a very unstable non-equilibrium. And I wouldn't bet my kids' savings that we can stay in this state for another 2 years. I could be wrong. Maybe there's a muddle-through scenario where we just sit here and do barely enough to get the job done. But I think eventually the financial markets will lose confidence and force the issue. Personal judgment, I can't prove that. What are the key elements of uncertainty from the point of view of investors? Answer, they don't know whether the reform processes will work, and that, is, to use my older framework, is not a question of resources, and it's not anymore a question of competence. It's a question of will. They don't know, to put it in its bluntest possible form, whether the political system here will be able to get behind a comprehensive set of reforms, and everybody knows what's on the list. You know, growth-oriented investments, labor market flexibility, a reasonably efficient government, meaning reduction of waste, some additional elements of competition policy, reduced tax evasion over time. And every country has their list. I'm not picking on Italy. I mean, the lists are slightly different, but essentially we've all got these problems. Why is this hard? Okay, so if you take the excess consumption deficient investment model, you're basically borrowing against the future. Either the government's doing it for you or you're doing it yourself. When the system breaks and people lose confidence in its sustainability, then you basically have to do something else. And the two things you have to do is pay for the past overconsumption and invest in the future in order to generate the growth. That's a double burden. And it lands right on the current generation and the next one. And it's not fair. And so then there's a huge issue, social issue, since this is a big burden, a big cost to get the fiscal situation in order and jumpstart growth with real investments in various things like education, human capital, technology, infrastructure. Again, it varies from country to country. So we got to divide up that burden among ourselves, regardless of the country we're in. And if we can't solve the problem of fairly dividing up the burden, then the political system will lock up, and then we won't do the reforms, and then that part of the system will start to fail. And that's not just an issue here. It's an issue in Spain. I'm quite terrified. You know, the young people have 50% unemployment. The overall unemployment rate's 25%. You know, there's a huge issue of kind of fairness in terms of what's going on now that may not get resolved in the course of the political debate. But as Mohammed Arian said in his really well-known and rather important book, When Markets Collide, you can't be an investor now without being able to think about analytically political and policy-oriented processes. You can't just focus on markets. It's not possible. And we're living in real time in that world. Why are the investors not coming back? Well, they're a little bit scared, but mainly they're not sure that these reform processes will garner the political support. There's one other thing they're not sure of, and that is they don't know what the European core is going to do. They do not know what the ECB and the IMF are going to do. And one of the reasons they don't know, meaning they don't know if they're really going to be circuit breakers. Now, some people think they don't have the resources. I don't believe that. But that's a kind of technical debate you can have. But most of the uncertainty is about whether they'll intervene at crucial points. What does history tell us? Not much. There was a bit of intervention in the sovereign debt markets, and then last fall, the ECB got reined in and said, well, that's not actually what we do, and furthermore, it's not legal. That's not part of our constitution. And then they intervened to the tune of 1 trillion euros in the banking system, and it spilled out into the sovereign debt markets, and Mario Draghi is a very, very smart man. And he knew perfectly well what he was doing. And it helped stabilize the thing and buy time. So maybe we'll actually have the intervention, but what we don't have is a clear statement. And we have lots of foot dragging on the German side because they don't like it. It has transfers embedded in it, or potential transfers. Now, they're not very dangerous. If the reform processes work and the ECB intervenes and stabilizes the sovereign debt markets by buying the sovereign debt, they're not going to lose a lot of money in the end if it all works, right? So why is the center so reluctant to make this unconditional commitment? moral hazard. It's called political moral hazard, right? They're worried that if they intervene in such a way as to make an unconditional commitment, then the political pressure, you know, the pressure on the political system to complete the reform process will be lifted up. So now you can see, I think, the moving parts and the complexity of the game we're playing and why it has this characteristic that it's sort of multiple equilibria. I think I put on an earlier slide, but these are things that Mohammed Al-Arian and the folks at PIMCO call known unknowns. That is, we know they're important, and we know we can't know in advance. So the mode we're in is watching, and to some extent holding back. Somebody has to move in this game if it's going to work. These are the bimodal distributions I told you about. I'll leave slides behind for those who are interested, but on the upper left is the euro-dollar exchange rate. These are one-year rolling returns compiled by Deutsche Bank. The upper right is Greece, pretty dramatic. The lower left is Spanish 10-year bond yields, and the bottom right is Italian 10-year bond yields. Pretty clear. These are bimodal distributions. These are very hard environments to invest in, by the way. You know, you can bet on the good distribution and try to hedge the downside distribution, but it's not easy to hedge the sort of, that's not a lower tail, that's a whole other part. And what these two humps are the two scenarios we were just talking about. You take a weighted average, and then when you get scared, the weights change and the relative size of the humps change, but they're still there, right? This is the euro-dollar exchange rate, and I think Bob Mundell's right. You may not agree with his proposals for the global monetary system, but these are the two largest economies in the world, with the next in line being China at half the size. And these are the two most important currencies in the world, and that is ridiculously volatile. Nobody would design something that looked like that if you wanted to limit risk, promote investment, or do something like that. And that's just a kind of preview of the fact that longer term, in fact, a generation's worth of longer term, we've got a whole lot of work to do to rebuild a lot of things, including the international monetary system. But this is not good. So here we are. The eurozone is the center of macroeconomic risk. The keys are Italy and Spain. And I think I've covered most of what I wanted to say about this. This is a list of Italy's kind of characteristics. It is the third largest sovereign debt market in the world. I think anybody who thinks that this whole enterprise can, meaning the reform, stabilization, and so on, can fail and have the eurozone survive is wrong. I mean, it's just not possible. Maybe Spain, certainly Portugal and Greece if the contagion effect doesn't kill us, but not Italy. The overall debt's okay, household debt's low. That means consumption tends to hold up, you know, when their assets move around. It's pretty tough here. There are real problems, notwithstanding the dynamism of the North. There's a competitiveness problem and some other issues, but it's not an unsolvable problem if we get at it. What to watch? Last thing on Europe. Status quo is an unstable non-equilibrium. You know, if you're an investor or anybody else in that kind of category, you got to keep paying attention. It changes day to day. I believe it will break one way or the other. I believe Greek will default and exit, actually, in some form or other. I think, if I had to bet, that the ECB and the EU and the IMF will step in and stop the contagion or limit it so that we don't unravel the whole thing in the very short run. And then the reform momentum in Italy and Spain become the key factors at the national level, and the ECB's continuing to act as a circuit breaker until, and this is the turning point, the tipping point where you know the bad equilibrium is going away. If you see the flows of private capital coming back into these sovereign debt markets, then you know you've rounded the corner. In the longer term, the monetary union is unstable if you have uncertain fiscal discipline, limited or reluctant fiscal transfers, and increasing generation by generation, but still not complete mobility of people. And that's not news. I mean, there's a recent book by Paul de Graw on monetary unions, written, I don't know where he wrote it. He's in Belgium and the United States. It's very good. The people who put the eurozone together knew this. They weren't even slightly stupid, and they thought it was the first step in a process that was leading toward political union. I think you all know that. And so now the question is whether that process will move forward, but if it doesn't, this will be an unstable structure, and it will stay unstable. We'll find new ways to destabilize it. So that in the longer term, I think that's the central issue. There is a tactical issue. So the conventional wisdom a year ago was stabilize now and deal with institutional and constitutional reform later. And last fall, Chancellor Merkel said, no, actually, we're going to do all this at the same time. There was a gasp, you know, pretty much from everywhere. You do it all at the same time? You got to be kidding. And then, of course, people sat down and thought about it and realized this is an example of crisis as motivation. And she thought to herself, I suspect, not having talked to her about it, that if we stabilize this situation and then go around and ask both people and governments, how do you feel about major constitutional change and centralization and unification, they probably say, well, not right now, you know, maybe later. So she thought, we're not going to do that, we'll do it now. But that doubly complicates the agenda as of about midway through last fall. And finally, there's a huge debate about austerity versus growth. I pretend sometimes to know something about growth. I think this is a false dichotomy. Austerity, in the sense of getting the fiscal situation on a reasonable timescale under control, is for sure important, and it certainly places constraints on the actions you can take to restart a sustainable pattern of growth. For example, it limits government's investment potential. So that's all true. And I think it's probably also fair to say that at least in some places there's been an overemphasis, perhaps with too high speed, on getting the fiscal house in order, and not enough emphasis on what do you really need to jumpstart growth in the medium to long term. I think that's all fair, but fixing the fiscal situation and restarting growth are very closely positively connected. I mean, if you were sitting in Greece now and asked yourself the question, can we fix this situation, you know, with massive government debt with no growth? You would conclude after a very short period of time the answer is no. And the same is true virtually everywhere, only it's less dramatic. The easiest way to lower the Italian debt to GDP ratio is to restart the growth engines. Now, we could spend, you know, hours and hours talking about that, and you'll probably get a hint of it from me in another couple of minutes. But let me just say one thing. I listen to a lot of discussions of growth, and I have a bad habit. Some of you may know the television program Jeopardy, you know, where you sort of are told an answer, and you have to guess what the question is. So when I listen to somebody talk about growth, I guess what their growth model is, because it's not stated. And I'll just report to you, the range, the variability in what people think is a sort of necessary and sufficient set of conditions for growth in advanced developing countries, just all over the map. It's really a dysfunctional part of the discussion. Let me switch to the United States. We have a brewing storm that is not yet fully reflected in pricing in the markets, and I think it's not something that people are fully aware of. But after the presidential election and before the president takes office, in what's called the lame duck period, we have three fairly major things that will happen. One, we will have the debt ceiling discussion again, and the last one was a fiasco and resulted in part in a downgrade of American sovereign debt. Remember, American sovereign debt is either the or one of the risk-free assets in the global economy. So we are now operating, I think it's fair to say, without a risk-free asset. I mean, this does all kinds of interesting things to finance theory, for sure. For those of you who know finance theory, you know, your risk preference determines how much of the risk-free asset you hold and how much of the market portfolio you hold. If there's no risk-free asset, you have to re-optimize the market portfolio every time you change your attitudes towards risk. It's hopeless. Oh, so we got the debt ceiling coming up, the Bush tax cuts expire, they're big. They're big. And finally, the payroll tax holiday disappears too. So if we don't do anything, because the president and the Congress don't agree, or we're gridlocked the way we have been for the last couple of years, there will be a massive effect on the economy, negative effect on the economy and on the financial markets. And if, in addition, the markets conclude the government's incapable of acting, then this thing that's over there on the other side of the Atlantic that's been a bit of a safe haven, sometimes described by people as the least dirty shirt in the closet, could conceivably blow up. I don't want to scare you, but nobody needs to be sanguine about the American situation. So there's nothing, there are special features of the European situation, but the potential instability is not confined to this part of the developed world. Let me just take you on a quick tour. The blue line is the post-crisis performance of the American economy in multiple dimensions compared with other things. It's pretty easy to get the message. This so-called recovery has been next to non-existent and awful and slow. So the top left is GDP. The top right is gross private investment, and the bottom left is government expenditure. And you can see the government expenditure went up, and now it's coming back down because of fiscal challenges. So we're losing the stimulus that went with that. That is adversely affecting growth. And here's employment. Basically, employment dropped off a cliff and stayed there. These are two different measures. One is the civilian employment population ratio. That's how many people are employed compared to how many people they are. And the right-hand one is total employment, literally, by numbers from Establishment Survey. And the starting point of all these graphs is where we were just as the crisis or recession hit. Okay, so it's all conditional on the starting point. So we have, almost 9% unemployment and another sort of 8 to 9% of people who've given up or are working part-time or something, and that's good compared to some other countries, including over here. So this is causing sort of major questions in America. The only piece of good news is the American economy has started to structurally adjust. So exports have actually outperformed, and imports are just back to where they were. The current account deficit is coming down, and America is becoming slightly more competitive on the tradable side of the economy. So I did a study. I'll share it with you briefly. We could spend a lot of time on this. But I want to suggest now that in addition to these short to medium run challenges, there's big challenges in the global economy, and they're structural. And I don't want to convince you that any of us knows the solution, but I want to convince you that we got to learn how to think about them. So what I did is I took the American economy sector by sector with my co-researcher and author, Sandile Halachwayo, very smart young South African woman who's a PhD at Berkeley now. And we basically tracked the economy for 18 years, from 1990 up to the start of the crisis in 2008, and asked where did it generate employment and where did it generate value added. If you don't like that term because it sounds technical, think output. But it's the output net of the inputs for an industry. And we divided the economy into two parts. The data don't let you do this perfectly. Into a tradable part, that's goods and services that trade internationally, like manufactured goods, like consulting, like finance, like designing computers, like lots of things, goods and services. And then a non-tradable part. It's huge, the non-tradable part of any advanced economy. I know this terminology is a bit unfamiliar to you, but it's much better than exports and imports. Because in a big economy like the United States, the stuff that's in the tradable part is frequently produced and delivered to the domestic market. So you never see it in exports and imports, but it's subject to competition, right? So that's the reason for the tradable, non-tradable. So what's in non-tradable? Government, healthcare, construction, retail, hotels, foods, restaurants, most legal services because they don't move across boundaries very effectively, et cetera, et cetera. It's a very large part of an economy, both in terms of value added and employment. So then we looked at the American economy sector by sector and added it up. We created in that period of time, on the other side of the Atlantic, 27.3 million jobs, and to a first approximation, all of them were in the non-tradable sector. Now, I said this about a year and a half ago, and there was a sort of shocked silence, because nobody had thought about it that way, and they were sort of, that can't be true. And then I said, well, this probably isn't a sustainable growth model from the point of view of the underlying structure. And most people agree with that, but we're not absolutely sure. If you look at value added, that's actually not what happened. Value added on the two sides of the ledger, tradable and non-tradable, was pretty balanced. They grew at about the same rate. So then you look at value added per person employed, which is quite closely correlated with incomes. And what you see is pretty clear when you think about it, which is on the tradable side of the economy, we generated a lot of value and no employment. So value added per person shot up and incomes went up. And on the non-tradable side, we generated a fair amount of value and we used it up employing people, right? So value added per person didn't grow up. So in the American economy, the tradable side didn't generate any employment, and so people moved to try to find employment on the non-tradable side where there's no international competition. They found employment. We didn't have an employment problem until the crisis, but they held down, competitively held down their incomes. Now, if you really look into the data, what you discover is that was the middle income group. They're the ones whose jobs disappeared in large amounts across the economy, but from globalization on the tradable side. And the people at the upper end of the income education spectrum are actually having quite a good time of the whole thing. And this you can't read, but basically what it is where did the employment get created and where was it lost? So that huge spike on the right-hand side, that's healthcare. And the next biggest one is government. And the other big ones are construction and retail and hotels, foods, and restaurants. And if you look at the tradable side, what you see is manufacturing declined, and then a bunch of service industries grew, and it netted out to zero. I view this pattern is now broken, right? It's one of the reasons we're not growing, and it's one of the reasons we're not employing people. We don't have enough demand, and there's no alternative on the non-tradable side, but if we restore the demand on the tradable side, because there's growing parts of the global economy, it's not an employment engine, right? So we actually have, this is our version of a competitiveness problem. And we're just starting to learn to think about it and think it through. I'll do this really fast. So on the left of each of these charts is Germany, and on the right is the United States, which you've already seen. So this is employment, and you can tell clearly the German economy didn't behave the same way. It generated pretty balanced employment between the tradable and non-tradable sides. The time period's a little different, 95 to 2000 and something. And this is value added, and I'll just skip ahead. And so you don't see this big divergence. One of the reasons for this is Germany, and this is important to the European situation, is Germany had a huge productivity, employment, and competitiveness problem in the year 2000, roughly. It had ingested East Germany at par, and it had rigid labor markets, and it was just going to get killed. And German business and labor and government sat down and without sort of terribly great initial agreement, said, basically, we can't do this. And they went through a set of reforms that involved labor market flexibility, rebuilding the social safety net so that they didn't depend on plants and towns and specific jobs remaining in place. And they held down the rate of growth of incomes to kind of get that component of competitiveness down. And they did it across the board. So you don't see this spike at the upper end of the income distribution in Germany. And finally, and this, I did talk to the previous chancellor, Schroeder, and he said, and I lost my job doing it. So I just leave that with you, but ask yourself the question, how many heads of state do you know who are willing clearly to set out to do something important knowing there's a pretty good chance they'll lose their job? Now, one of the reasons the Germans are where they are is because they went through this set of reforms. And one of the reasons their attitude toward the rest of us is what it is they think other people can do it too, and we haven't gotten around to agreeing to that. Now, that doesn't mean that their approach to stabilizing Europe is right, and they for sure don't want to end up being, in the end, the reason the eurozone and the European enterprise came apart. So they're not going to do that in the end. But the political leadership in Germany has to deal with the fact that a bunch of people were participants in this reform process. They understand it pretty well, and they kind of think everybody else ought to do something similar. This is the American income distribution, and I don't have to explain it to you. The middle income group is not experiencing growing incomes, and the top part is. It's that simple. This is I'll leave this with you, but these are the income distributions for a variety of countries. If you compare the United States and Germany, let's take the top 20% to the bottom 20% average incomes. The ratio in the United States is 8.4. In Germany, it's 4.3, about half. Okay? These are the same kind of advanced economies subject to the same technological and global market forces, relatively highly competitive, and one of them produces an income distribution that's twice as unequal as the other. I can't explain that, so I leave it with you. But it sure isn't just markets. I'll skip over this. These are the PISA scores, and if you want to scare yourself, these are the OECD-administered scores that compare countries in the performance of students in their mid-teens. And it's quite alarming what's happening in many of the advanced countries. And finally, on this score, this is the cross-country picture of how much of total income went to labor. So it rose nicely in the early part of the post-war period, reached a high point of close to 60%, just under. And then in the mid-70s, it started down. And it's been trending down ever since. So where's the income going? And the answer is, it's going to the owners of capital and the owners of valuable human capital. And this is a world where hundreds of millions of people are entering the global labor force, where technology is taking away mid-skill, mid-income jobs. And so you can see this pattern. These are very powerful forces. They're not easy to reverse. And you see it in the advanced countries, and you see it in the developing countries as well. I'll skip over that. I think I'm almost out of time. And so, 5 minutes? Okay, then I'll let you read the book, and I won't repeat this. In one sentence, the developing countries started growing for the first time after World War II. They're 80% or 85% of the world's population. We're halfway through a century in which they join us. And in the course of it, they'll make the global economy about 4 times as big, even that it is now. It's the major trend of our time. This is what high-speed growth is, and those are the key elements. You'll have to read the book. Let me tell you why it matters, if you're interested in sort of whether we're going to pull this off in the next 50 years. Now, I'm proposing, I care about this mainly because I care about my children and grandchildren. I propose to watch most of this from a beach somewhere, but I'm not sure this is going to work. So this is a picture of global energy consumption out over the next, 90 years or so, and it's not controversial. You can quibble with precise numbers. It's going to be a huge amount of increased energy consumption, and virtually all of the increase is going to be the developing country growth. This is a picture of commodity prices in the 20th century and coming into the 21st century. They were pretty high back around World War I. They came down. They were pretty flat. And then after the oil spike, the creation of OPEC and something in the 70s, it's actually been drifting down, oil, other commodities, in real terms. It's just reversed dramatically, right? And there's no reason to think with the kind of demand that goes with the developing country growth, that this pattern's going to change. Now, how fast it'll go up and when it'll sort of level off, you know, takes very complex technical calculations, and I'm not going to bore you with any of that. But you can see, once again, the developing countries have been growing at high speed for a long period of time, but it didn't matter. China was growing at 10% a year 25 years ago, and the change in the global economy was negligible. Now, when China grows at 10%, it's the equivalent. It's the equivalent of Europe or America growing at 5%, and that never happens, okay? That's why it's so important. It's just that they've gotten big. The developing countries are basically at the point of passing 50% of global income and output. That's where we are. It's kind of an inflection point. This is a picture of McKinsey Global Institute's estimate of what's going to happen to the global investment rate. It's been declining because it was dominated by the advanced countries and we didn't have war recovery anymore. And it's about to reverse because the developing countries have to build cities and so on. You can go through index after index of thoughtful analysis and you get the same picture, you know, in a slightly different dimension. This is China's effect on manufacturing prices. They're so big now, they're driving down the relative price of manufacturing. And these are CO2 emissions. This might interest some of you. So at the left-hand side of that graph is the per capita output of carbon dioxide, not carbon, carbon dioxide, in tons, and the number is 4.8, roughly. The scientific input says we'd be much safer, not completely safe, but safer at 2.3, so we're about double where we ought to be. And then you have countries. So the outliers are the United States, Canada, and Australia. We're at about 20 tons a person. And then most of Europe is in the sort of 10, 11 range, ranging down to France at 6 because of nuclear energy. And then China's at the world average, and most of the developing world is way, way down. Of course, that's exactly what's going to change. So if you draw a picture, I'm not going to tell you how we're going to tackle this because nobody knows, but if you draw a picture on this graph, you can see in 2009, the safe level in aggregate output is about 15 tons, billion tons. We're at about 30. And if we just go on autopilot, we'll go to 60 over the next 30 or 40 years. 30 is fairly risky. 60 is ridiculously risky. One more sort of sustainability issue that we have to deal with. So finally, I'm going to skip decoupling and tell you that the one other thing that I track pretty closely is China. And the reason is it's significantly important. It's the major growth engine left in the world. It's entering what's called the middle income transition, which is a very, very complex, difficult part of a 50-year journey, you know, of economic development, starting at, you know, $300 of per capita income and ending up at $25,000. And it's never been tried at the scale China's trying to do it at. And it's important. I mean, if you look at countries around the world and ask what's their major export market, you know, for India, Brazil, Korea, Japan, Australia, Argentina, just a growing long list of countries. This is their major market now. If you go and ask anybody in this audience who lives in the luxury world, ask where's their growth coming from, you'll get the same answer right there. So it matters. This is a picture of countries that entered the middle income transition at high speed, 7% per year growth, which most of us haven't experienced. That is most of us in this room. And most of them stop. So if you're one of the people who likes to estimate the odds not on analyzing the situation, but rather on, you know, how many people have done it successfully before, the answer is not very many. In fact, the list of successful transitions is rather short. It's got 2 city-states on it and 3 countries. So it's hard. And I think that, so I'm going to tell you, there's lots of components of this. You know, they've got to get consumption up. They've got to get rid of the low return investment. They have to transform the tradable sector so it doesn't do labor intensive stuff because the per capita income makes them uncompetitive in that. They're going to export something on the order of 85 to 100 million jobs to the poorer parts of the developing world who are growing. It's just a gigantic opportunity. Bottom line is it's got a lot of moving parts, and they understand it. So their challenge is an implementation challenge. Now, those of you who read the kind of global press will know that there's a bit of a noise coming out of China, and it surrounds this party secretary in Chongqing named Bo Xilai, who was fired for a variety of offenses, including brutality to the mafia, corruption, and a bunch of other things. And some people think there's an ideological battle going on within China over the direction of change. And I'm here to tell you there's a bit of that going on, but most of what you hear out of China, and I'm going to stop at this, is a battle of vested interests. So there's a huge set of vested interests in the state-owned enterprises. They own half the net fixed assets in the economy. The government owns at least 90% of these companies on average, and they don't dividend out any of their income. They just invest it. This is a pattern that, if it continues, will actually kill the growth process. So there's actually something really important at stake in China, and that in the medium term, on a secular horizon, and that is whether the reformers win this battle and whether there's a parallel set of political reforms that probably over time will make China look more like us in terms of the way we function politically. But that's all the main area of uncertainty. I think with that, I probably said enough. So I'm going to thank you very much for listening to me and sit down.